Today it's
Okay.
806, so it's grown. He said, "What are you doing?" He said, "You submitted a file with all of these tax returns and bank statements and business documents." He said, "It's the same rate on a no doc loan, which means whether or not you put any of this in or submit any of it, it's the same product for the borrower." So I said, "Well, what do you
Wow.
want me to do?" He said, "I want you to resubmit the loan. I want you to take out all of the tax returns, take out all the bank statements, delete everything in the application in terms of
Wow.
assets, employment, and income, and resubmit a blank application with no documents because the borrower is getting the same rate and the same deal." And I said, "Well, that makes sense, you know? I mean, let's." And so then I was like, "Man, that is wild." And that's what people started funding on. And then all of a sudden,
Yeah.
surprise, surprise, those people weren't able to refinance because they didn't actually have jobs. They didn't have, they couldn't make their payments. So the world crashes. My business partner and I had two totally different ideas of what to do when the real estate market crashes. And so we split our ways, we went our own ways, and I
Okay.
went into my home office and just to figure things out, like what are we going to do? It's March of 2007. The stock market's
Whoa.
going nuts. The real
Yeah.
estate market is crashing. I love what I do. Um, what am I going to do now? And I just started calling old clients and building relationships with people. And I found like, man, I have so much time now to spend with the clients because I'm not managing 40 employees in an office and running,
Right.
doing pipeline meetings and training appointment setters and telemarketers and all this. I can use what I know and just help people. And so I built a word of mouth business just on that. And that is what today, I'm still a broker. I was with the bank for a while because you kind of had to be after the crash in 2010.
Okay.
But now I went back to the broker platform because the broker platform in the mortgage world, and we'll get into the differences, but the broker platform is where you can obtain the lowest rates, lowest fees, close fast, and do it based on just Fannie and Freddie's guidelines, which keeps the
Okay.
paperwork down. And I want to get into that because when I'm educating people, I thought it would be cool for this call to to let's lift the veil on the mortgage business. Like it's not
Sure.
a mystery. There's no secret. It's really actually pretty cut and dry. So
All right. Yeah.
that's what we'll get
Like,
into.
open it up. Like if you're a first time home buyer, let's take a couple of stabs. Like first time home buyer, then maybe like somebody like I really feel like currently in this market because when we had the rates so low and people locked in under 3%, they are scared to leave that, right? But they're
Well,
being
100%.
consumed by credit card debt because they've had to utilize that because they don't want to refi. And A, it's hard to get a
That's a
refi, and
that's a
B,
good point.
they don't want to lose that 3%, and but yet they're hoping things are going to change, so they put it on the credit card, hoping that things will get better. And we're almost 3 years into this stagflation type of scenario. And so I
Well,
think that
yeah.
would be something for you to talk about. So, oh yeah, please open up about what does a first time home buyer, what does it realistically need to know on your end of the ball, or your end of the field? What do they need to know to move forward?
Well, I think one of the biggest concerns with a lot of first-time homebuyers that I talk to is that they're apprehensive about buying a house because they heard the stories of their parents or they heard the stories. Maybe they're trying to re-enter the market and they remember 2008 through
Mm,
2011 and they
yeah,
remember
right,
buying a house. They remember buying a house for uh, $400,000, and then
right,
a year and a half later, it's worth 250, and they're
right.
$150,000 upside down. And so they're like, well, I don't know. I know that you can. People have lost their shorts, but I educate people that that was a totally different time when that happened. That was a no doc blank application. It should have never happened. Nobody ever went to jail for it. And it's pretty well documented in a couple of really good movies. If you want to learn about what happened, there's a documentary called Inside Job that really, really does it. The Hollywood version is called Big Short. It's pretty
Yeah.
much the same. It's the same deal. It's the
Yeah.
same
A little
events.
more
The
fluff.
inside job is pretty eye opening. But anyway, a lot of people are concerned about that. So their biggest concern is what if home prices just plummet, and they kind of solved that after it was the Obama administration that came in and created the CFPB, and they created it was out of the Dodd-Frank Act, which
Yeah.
created the ATR, they call it, the ability to
Okay.
repay. And so now every loan since that whole crash is based on a minimum down payment. It's based on people qualifying for payments that they can prove that they can pay through their pay stubs or
Okay.
their jobs. So housing now over the last 15 years has been propped up by people that can actually pay the bills, and it's not garbage. What
Okay.
happened in COVID was that when COVID happened and the world was crashing again financially, housing didn't, because the Fed stepped in. They cut the rates to zero. Rates went from in the five-ish neighborhood percent down to many times under 3%, but it's three
Yeah.
percent, the 2.5, and so everybody that owned a home at that time refinanced their mortgage,
Of
right? Like if you're
course.
going to cut
Yeah.
your payment in
That
half,
was that
every
was my
single
best
person
season.
refi.
I did so many
Oh,
homes during that time.
it was the biggest refi boom of our lifetime,
Yeah. And
and
it
it
was
was
it was
also a purchase boom too.
and I knew something was different too because we're lucky enough to live in Scottsdale, and a lot of the big money people were refinancing their homes.
Every
So
single
here I
person that
am.
had a mortgage refinanced,
Yeah, I was
and,
I mean,
and
I was appraising $5 million homes like as if it was just a typical day at work. You know what I mean?
well, if
And
you
that
had a
told
loan on your house, you were, and a lot of the people, the high net worth people, were they didn't have a loan they were paying off. Maybe they were free and clear
they
on
just
that
owe
$5 million
money,
second home.
cheap
They
money.
were just, if they can get $2 million at 3% and put it into a something that can make
Tesla
10 to
stock.
15%. I mean,
Yeah,
it's a no brainer. So
yeah,
that's exactly though what has kept, because then in 2022, March of 2022, when all of a sudden, you remember, so the aftermath of COVID was
oh, yeah,
supply chain. You remember supply chain?
yeah,
Like lumber tripled in price,
yep,
and
yep,
all this stuff was going on. Gasoline was going up, and because the what was it, the Suez Canal was blocked, and you would see these things, and nobody could get the stuff off of the
right,
crates, and from China. It was this wild stuff, and so inflation went through the roof because
yeah,
all this free money was out there. And so they
yep,
had to, real estate was just going nuts.
yeah,
Rates went in March of 2022, rates went from 3% to 6.5% in like 90 days.
yeah. It
And
was a
it
blink of. I
was,
mean, talk about feeling the pinch as an appraiser.
it was the opposite of the COVID crash in rates, because all of a
Yes,
sudden, overnight, nobody's refinancing.
right.
Because there's nobody,
It was
everybody
done.
already got their 3%. They're
It
no
was
longer
done.
going to get nobody's going to go from 3 to 6 to pay off a credit card.
A hundred
So
percent.
it was just over.
Yeah,
And it was in the 6%. And then everybody's like, well, don't worry, it's just bouncing up a little bit. Now it'll, come back down. And then 2023, they continued to go up. And
yeah,
inflation continued to increase, and the rates were creeping closer to 6.5, and then high sixes, and then don't worry, rates are coming down, and then all of a sudden 2024, like don't worry, this year they're coming down, and then they would got up to 7%, 7.5%, seven. Some people were calling for eights and nines on conventional loans, so
right,
people were flipping
right.
out a little bit, and they kind of put the brakes on buying. Nobody was selling, because if you owned a house at 3%, you're not going to sell that and buy
Where are you
something
gonna
else, so you're
go?
holding on. And that
Yeah,
that kept inventory artificially low. So there
right.
was no houses on the market. But
Yeah,
people are still living life, and new home buyers coming in, and people want to buy a house. I mean, buying a house is a part of the American dream. You own your
right.
own property. You're no longer renting, because when you're renting a house, you're just paying somebody else's mortgage. And that's what one thing I tell people. They're like, I'm nervous. I've never had a mortgage. And I say, well, are you renting a house right now? And they say, well, yeah, we've been renting this house for 5 years. I said, well, you're paying a mortgage.
Yeah.
It's just not yours. You're building
Right.
somebody else's equity.
Right.
So, but they were apprehensive because they were like, well, I don't know if I want to buy because, I don't want the house to crash like it did. But everybody was buying based on their merit to pay the bill and their minimum down payment, which has been put forth by Fannie Mae and Freddie Mac. And so now we're at the point where rates are starting to come down a little bit. Uh,
Yeah.
we're in the sixes. I'm no longer,
Yeah.
unless it's an
We
investment
just dipped
property.
today. Did we dip today below 7?
Today was really good. I'm locking a lot of people with a 6 point something. It's high sixes, but
Yeah.
we're out of the mid sevens.
Yeah.
And now the feds are talking about maybe starting to decrease the Fed rate, which is not the same as mortgage rates. It's not directly tied, but
Right.
it does have an effect. And so over the next couple of years, rates are going to be falling. And so the people now are like, okay, well, I talk to so many people that are on the fence. They want to own a home, but they don't want to buy because they got parents in their ear or whatever. They've got people, well,
Sure.
don't buy when it's a 7%, the pay.
Sure.
Well, if you're waiting to purchase, that's when COVID rates dropped to 3. That's when housing took that huge jump. I mean, housing went on fire because lower rates make it more affordable. You get more buyers, more people can afford the payment at the lower rate.
Yeah.
So then prices go up because now you've got competition on the buyer side. And so that is what's going to start happening coming forward. So we're in the tail end of the highest rates we've seen in the last 10 years. So if you buy now, then you can always
You got
just
refinance room.
you refi later, but you're buying at the price now. If you wait for the rate to be lower,
Yeah.
and you wait for the rates to build into the coming increased real estate value, then you're missing out on the equity. You might have the low rate, but you're buying at a higher price, so the payment's the same as if you buy now, but you
Right.
lose the equity and you're still going to be in the same payment anyway. So I'm educating people that don't worry about what had happened because today's mortgages are all built on the ability to repay and they're scrutinized. And when I talk to a first-time home buyer, the very first question I ask them, and I ask this to everybody, whether they're a first-time home buyer or not, but I always gauge people's knowledge of, have you ever heard of Fannie Mae and Freddie Mac?
Hmm.
Because if you understand who Fannie Mae and Freddie Mac are, it takes the veil off of the whole industry and it starts to unlock these mysteries.